Welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have your USDs for our chart. All charts to be presented are to be of the same time frame unless otherwise stated. Mind you that today in the presentation, we're going to be mixing technicals with fundamentals. And starting with Euro USD, we made a slight recalibration. And we were about to actually correct the resistance support lines. Allow me to finish that off. We're setting the S3 now at 1.07, the S2 at 1.0765, the S1 at 1.0820. You must have noticed that the margins between the resistance support lines tend to be somewhat narrow. It's around 60 to 80 pips. And the final resistance line at 1.1040. Locking it in. Now, what we do note here is definitely the sideways motion of Euro USD. Despite a small break to the downside here, it was quickly recovered and the pair maintained its sideways motion between the 1.0820 and the 1.0990. Now, we could actually widen the levels a little bit. Let's have a look at that. And that would be set at 1.09795. Leaving the 1.065765 unchanged. Let's have a look for a new ultimate support line. We have a touch, but actually that's pretty narrow. In my opinion, that's not valid. I would be widening it as low as here. Note how the correction lower here was stopped and the pair was able to regain a bullish movement. It has also provided the resistance a couple of times. So that seems to be pretty valid. I'm keeping that. That would be the 1.0610. Readjusting the chart. Now we have widened substantially the resistance support lines. On a fundamental level, I would be noting here that we have market worries about inflationary pressures in the Eurozone. And today we already got France's preliminary HICP rate. That was for February. Now the rate slowed down, and that was on a year-on-year level. However, it actually failed to hit the market expectations. The slowdown was narrower than anticipated, even slightly. At the same time, we have to note that there were some conflicting messages coming out. As we saw the month-on-month rate actually accelerating for the second largest economy in the Eurozone. So that would be blurring the picture regarding inflationary pressures in France. I would be noting here that attention now turns towards Germany's preliminary HICP rate for February. In this case, once again, we see that the year-on-year rate is expected to slow down considerably, which may more or less weaken the euro, as that would be implying an easing of inflationary pressures in the largest economy of the Eurozone. At the flip side, though, it seems that the month-to-month rate may be accelerating, remaining unchanged, or even accelerating a bit, which could be implying once again that inflationary pressures are simmering also below the surface of the largest economy in the Eurozone, which could provide some support, or at least mix the signals coming out on the inflationary front. I would expect such a release to more or less, on the one hand, weaken the euro side of euro USD as widely. That would be sending the year-on-year level, would be sending a signal to the ECB that it could start cutting rates. But on the flip side, the month-to-month rate may more or less allow the ECB to maintain its rather strict monetary policy stance should the month-to-month rate accelerate as expected or even more. On the flip side, regarding the US dollar, we have a number of financial releases which are of interest. I would be starting with the core PC price index. Similarly to the preliminary HIC periods of France and Germany, the core PC price index on a year-on-year level is expected to slow down, but only slightly. While on the flip side, the month-to-month rate is expected to accelerate. And that could provide some support for the USD. I would be also noting here the speakers which are scheduled, Fed policymakers, which are scheduled for today. And I would be highlighting actually Cleveland Fed President Mester. Now, she's a well-known hawk. Most probably, she will be pushing back against any market expectations for extensive and early rate cuts. That could also be providing some support for the USD. So practically, on a fundamental level, I would say that Euro USD's direction seemed to be rather uncertain. On a technical level, I would be noting that we have Euro USD maintaining a sideways motion. That's obvious between the 1.0795 and the 1.0890. My worries or my expectations would be for the sideways motion to continue. The RSI indicator had reached the reading of 50 and has risen slightly, but nothing conclusive just yet. Yet there seems to be a slight, very slight bullish tendency in the market sentiment, which could push Euro USD higher. Our base scenario for the time being remains the continuance of the sideways motion. Yet should the bulls take over, I wouldn't be surprised to see the price action breaching the 1.0890, a level which provided resistance here and here. And in that case, practically the way would be paved for the R2 1.0982. On the flip side, should the bears be in charge, I would expect the pair to drop, break the 1.0795, and start aiming for the 1.0765, a level which provides support back here, and was quite evident how that provided support for the pair. Okay, let's have a look at USD-JPY, which took the markets by surprise yesterday. It's going to be interesting in the sense that the pair note the wide drop, yet at the same time the correction higher. We're adjusting the chart in order to reflect exactly the downward motion here, but also widening to the downside. There you go. Starting now with the R3, which is being set at 153.80, that doesn't change. I would be also noting 151.90, noting practically a 30-year high. And drilling to the daily chart, you can see it here. Back to the 4-hour chart. Now, the R1 being set at 150.80. You can see how that provided resistance once, twice, 3 times, 4 times here. We have lowered the first support line and have placed it at 149.60. Let's have a look at the S2. The S2 which provided support down here, that was at 147.75. And also moving to the S3 at 145.85. A level which was tested or aimed for here. Locking everything in, let's talk direction. Now, during today's Asian session and the early European session, the pairs seemed to be decisively moving lower. There was a strong bearish sentiment, which more or less brought the pair as low as to test the 149.60 support line once again. The pair has corrected a bit higher since then, or at least stabilized somewhat, so there is some hesitation. In my opinion, though, I would expect the price action to move lower. And I'm mentioning this practically on 2 reasons on a technical basis. The first is that the slowdown of the bears may have been caused also by the fact that the price action practically broke the lower Bollinger Band and was forced to stabilize somewhat. At the same time, note how the RSI indicator dropped almost to the reading of 30, and despite a slight correction high, is still at very low levels, which implies that there's still a bearish sentiment in the market left. Yet for a clear-cut bearish outlook, I would require the pair to clearly breach the 149.60 support line and start aiming for the 147.75. On the flip side, should the bulls take over, we may see the price action breaching the 150.80 and start aiming for the 34-year high of 151.90. For the time being, we expect once again the pair to remain in a sideways motion between the R1 and the S1. That's obvious. And for a downward motion, let me repeat it, I would require low truth on this one. So the price action has to breach below the S1 149.60 clearly. Moving now to USD CAD. Actually, before moving to USD CAD, there was a development which may have been also the catalyst behind the strengthening of JPY today. We had comments from a BOJ policymaker where he stated that the bank's inflation target has come into sight. Now, the statement tended to highlight the prospect of the bank to actually hike rates. Market expectations are for the hike to happen in April, with another one currently being expected to follow. That would be in September, and a third one being possible in December, but I think that's a little bit far-fetched. More or less, I would note that what happened during today's Asian session with JPY was characteristic of how BOJ's intentions are a catalyst for the direction of the Japanese currency. And we may see the monetary level actually dictating the direction further in the coming days. Now, moving to the Canadian dollar. Now, the CAD was able to break the 1.3570 and stay above it. So for the time being, we are treating the 1.3570 as a support line as it was verified. And note how the RSI indicator is nearing the reading of 70, implying that the bullish sentiment is strong in the market. So I wouldn't be surprised to see the price action rising, aiming for the 1.3675, if not even breach it. Mind you that we have also the 20 moving average. You can see the blue line here, which is the median of the Bollinger Bands. You can see how also the, sorry, give me a sec. Yeah, the 50 moving average, which is the green line, and the 100 moving average, which is the orange line, have all started to point upwards, more or less highlighting a bullish tendency among market participants. We note that the upward trend line, which was in place, seems to be now out of relevance in the sense that there was a triangle here being formed. The price action had a break to the upside and now has intensified its slope, has steepened its slope, like here. So I would expect the price action to remain in a bullish movement, possibly start aiming for the R1 1.3675. On the flip side, we have to note that any progress made by the bulls seems to be very slow. And I would be also noting that we had this peak, which was not able to be surpassed by the bulls yet, regarding USD CAD. That could be implying some stabilization of the pair. And I would expect any stabilization to be signaled by a breach of the newly drawn upward trend line, yet at the same time the price action to remain above or rotate around the 1.3570 level. For a bearish outlook, once again, I would require a clear break of the of the upward trend line, a breaking of the S1 1.3570, and the pair to start aiming for the 1.3450, actually reach it and breach it. So nothing less than a lower true than this one would be enough to actually signal the beginning of a bearish outlook. I would require the pair to drop, break the upward trend line, break the 1.3570, but also break the 1.3450, start aiming for the 1.3320. Mind you that today we're getting Canada's GDP rate. It's for Q4. It's expected to accelerate. And it's characteristic how the rate is expected to escape the negative area and enter to 0.8% quarter on an annualized basis. Now, this scenario would actually provide some support for the Canadian dollar, especially if the rate accelerates beyond market expectations. Should it fail to reach its target, or the market expectations, if you prefer, that could weaken the CAD somewhat. In my opinion, should the rate actually reach 0.8% or even surpass it, that would be signaling that the scenario for a possible recession in the Canadian economy tends to more or less fade away, and it could allow or ease the pressure, if you prefer, on Bank of Canada to start cutting rates. Both elements could be supportive for the Canadian dollar. But we will have to wait and see until we see the price action breaching the S2 for me to have an actually bearish outlook once again. Okay, let's move to the Aussie. Let's readjust the label so we get a clear picture. Okay, the price action has moved below the 0.6520 resistance line, and even the level has provided some resistance. You can see it here in the late Asian session today. I would expect the pair to remain in a sideways motion, but I would be also noting here that we have a downward movement, which is clear and it has to be drawn. You can see it how. There you go. See, you have a peak, a lower peak, a lower peak, and an even lower peak, while we have at the same time a trough, a lower trough, and an even lower trough. But for the bearish outlook to be maintained, you would require a lower trough than this one. So the price action has to drop below it and start aiming for 0.6440. Now, on a fundamental level, Aussie traders should be looking out for two elements, in my opinion. The first element would be the market sentiment. The Aussie is considered to be a riskier asset Give me a sec. Now, the Aussie is considered to be a riskier asset and hence is more sensitive to the market sentiment. Should the market sentiment be more positive, we may see the Aussie getting some support. On the flip side, should the market turn more cautious, then we may see the Aussie weaken. I would be also highlighting the release tomorrow during the Asian session of China's manufacturing PMIs. That would be the National Bureau of Statistics PMI and the Gaixing PMI, manufacturing PMI, both for the month of February. Up until now, we saw practically the figures more or less sending some mixed signals that was indicative that Chinese factories were struggling to keep economic activity afloat. It was characteristic how the NBS manufacturing PMI was repeatedly showing a slight contraction of economic activity, while on the flip side, the Gaixing manufacturing PMI was showing a slight increase. In my opinion, I would expect the situation in the manufacturing sector of China to deteriorate slightly, and that could darken the outlook for the recovery of the Chinese economy. Such readings could turn the market sentiment a little bit more cautious and at the same time imply that Australian exports of raw materials from us towards China may suffer another blow. So most probably the release, should the actual rates and figures come out as expected, may have a slight bearish impact on the Aussie. However, that remains to be seen. Okay, on a technical basis, once again, we tend to maintain a bearish outlook for the pair AUD-USD. We're noting that the median of the Bollinger Bands, the 20 moving average, has a downward slope, while the RSI indicator has dropped below the reading of 50 and remains between 50 and 30 right now, implying some bearishness in the market sentiment for the pair. Both elements could allow the pair to drop even lower. However, once again, that remains to be seen. We expect it, though, to start aiming for the 0.6440 support line. That's one. For a bullish outlook, as mentioned, I would require the price action to actually breach the R1 0.6520, and also I would require a breach of the R2 0.6575. We would require a higher movement, which would be more clear, more bullish, and would be dissolving the confusion around. Now, moving to GBP/USD. GBP/USD, okay, definitely we have to reverse the role of the R1 from a resistance line to support line. That's obvious. The price action has broken above it. And let's go hunting for a new ultimate resistance line. I'm setting it in this peak here. That would be in red. $1.2995, locking it in, readjusting the chart. Let's work with the labels as well. R2 being set at 1.2870. And the R1 at 1.2760. Let me confirm that. Yeah, correct. Let's move to the support lines now, starting with the S1 at 1.2645. Albeit, in my opinion, the second support line should be lowered. Being placed right here once, twice, I think that's obvious. And that would be the 1.2535. And the last support line being set at 1.2445 remains unchanged. Locking everything in, that's it. Now the prognosis about the direction is tilted towards a sideways movement bias. And that's evident in the sense that we saw an escape, or if you prefer, breaking of the upward channel to the downside, of which was practically directing the pair. And I wouldn't be surprised to see that being maintained just above the S1 1.2645. At the same time, please note how the Bollinger Bands have flattened out and remain rather narrow, implying low volatility for the pair, which could allow the sideways motion to be maintained. At the same time, also note how the RSI indicator is running along the reading of 50, implying a rather indecisive market. So that could be more or less also another signal for a sideways motion. Now for bearish outlook, I require a clear break of the 1.2645 support line, and even the support line at some point, should it be broken to the downside, provide some resistance to prove its worth as a resistance line and push the pair lower towards the 1.2535. On the flip side, should the bulls take over, I would require the pair to surpass these levels here and start aiming, if not breaching, even slightly, the 1.2760, a level which has provided resistance a number of times. You can see it right here. Okay. I think we covered the major FX pairs. Let's have a look at gold. Now, gold's price remains in a sideways motion. That's pretty clear, and that's evident practically from three factors. Definitely one is the sideways motion, which has been confined between the 2042 resistance line and the 2014 support line. At the same time, the second element which I would be highlighting here would be the narrowing of the Bollinger Bands, implying that there's low volatility. There's also some flattening out of the Bollinger Bands, and the 50 and 100 moving averages, all pointing towards a sideways motion. The RSI indicator, despite rising slightly, was not able to escape and actually returned back to the reading of 50, once again highlighting rather indecisive gold market, which most probably does not seem to be finding any direction upwards or downwards right now. On the other hand, should the bulls take over, I would expect the price action of gold to rise, breach the 2042 resistance line, a level which has provided resistance once, twice here, and most probably start aiming for the 2075. I know it sounds like a round figure. Allow me to note this resistance line, also how it had provided resistance back in the day here. While even higher, we note the 2136 resistance line, which forms, if I'm correct, record high level. Yep, here it is. This is the daily chart. Note how the 2136 actually was the peak of gold's price. Back to the forward chart. Should the bears take over, I would expect the price action to drop, breach the 2014 support line, and start aiming for the 1972. Now, some have argued that we could raise the support line all the way up here. I would respect that, yet I would prefer to keep the margins a little bit wide, and I'm practically choosing this true here to rest my support line on. Even lower, we note the 1930 support level. Now here we have somewhat conflicting fundamentals in the sense that definitely the relative inactivity of the US dollar, given the negative correlation between the USD and gold as trading instrument, the inactivity of the US dollar may have allowed also the sideways motion of gold's price to prevail. That's one. At the same time, I would be noting the path of US yields, and we may see also some volatility increasing gold's price in the coming week as we're nearing the release of the US employment report for February on the 9th of March, 9th or 8th of March, 8th of March. So keep an eye out. I think that we may see some bullish tendencies should the USD start weakening. And at that point, we have to note here also a possible drop of US yields could be supportive for gold's price. So keep an eye out. Let's have a look at WTI. By the way, we're going to be issuing the weekly outlook for WTI's price action, and that's going to be including also fundamentals. For the time being, we definitely highlight the sideways motion. It's pretty tight, and that's between the 78.35 and the 75.65. It's characteristic how the price action seems to be confined, at least the main body of the price action since the 7th of February has been confined within a corridor which is about $2.5. It's very low volatility for oil price and especially WTI. For the time being, we tend to maintain our bias for the sideways motion to continue. And at this point, allow me to drill out to the daily chart, which shows even more characteristically how the corridor is relevant. Back to the forward chart, we could widen it a little bit, make it a little bit more obvious. And at the same time, please note how the RSI indicator is at the reading of 50, running along, implying more or less a rather indecisive market, which could allow the sideways motion to be maintained. For a bullish outlook, we would require a clear break of the 78.35 resistance line, nothing like this. On the contrary, the price action has to breach it and start aiming for the 82. Some have noted, and I respect that totally, that we have a series of higher truths and higher peaks. It's an indication for a bullish outlook, yet for the bullish outlook to be maintained, we will need practically the price action to have a higher peak than this one. Once again, the 78.35 resistance line has to be broken, and the price action of oil has to start aiming for the 82 resistance level. On the flip side, should the bears take over, we would expect the price action of oil to drop, break the 75.65 support line, which has provided support beautifully once, twice, 3 times, but even further back, and as a resistance line. And in that case, the next possible target is being set quite low, $4.50 lower. Now, okay, not even $4.50, $4 lower at 71.55, a level which provided beautifully resistance as it reversed the downward motion at the last days of January back to an upward motion in the first days of February. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Hello everyone, my name is Emily. In our video today, we will talk about why having a forex trading strategy is important. Trading on the global forex market presents the opportunity for a quick profit turnaround for traders and offers significant potential. However, as the most liquid market in the world, it is both complex and highly competitive. This means that in order to be successful, you need to have a solid trading strategy in place. Forex can be traded in numerous ways, so it is very important that you go with an approach that suits your experience level, budget, and trading goals. Having a proper understanding of the market you're entering into and the strategy that is needed can be the difference between trading success and failure. Choosing a forex trading strategy is similar to buying a new car. There are a lot of choices and they come in different types. It is also important that you test drive a new strategy via demo account before proceeding with it on the real world markets. Thank you so much for watching us today, guys. Bye-bye.
Just joined, we're going to be talking about how you can set up your trading journal and a couple of important pointers as well. So before we get started, as per usual, a risk warning: our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suited for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. Redistribution. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We're gonna talk about how you can get the most out of your MyFX book. We're gonna talk about optimizing your strategy. So what's the best days, best times, best techniques as well. And also we'll be talking about the best direction. So how exactly you can do a bit of trend trading. Okay, let's get started. So what exactly is a trading journal? So it's basically like a diary, and it's a way for you to track your trading performance by recording all of your trades. So you can start a manual or an Excel sheet, or an automated trade journal. And I'll show you guys some examples in a little bit. So importance of a trade journal. So before we dive into the specifics, let's quickly touch on why exactly having a trade journal is crucial. So trading journals, as we mentioned earlier, serves as your personal trading diary. So it helps you to track your trades, analyze your performance, and ultimately improve your results over time. So some points on why exactly you should start using a trading journal. Firstly, is to track your progress. So it basically provides insights into your performance and helps you to identify patterns in your trades. This also helps you to learn from your mistakes because you are recording your trades and understanding the reasoning behind them so that you can learn from your mistakes, avoid repeating them in the future. Okay, so this self-reflection is crucial for continuous improvement as a trader. Next is to develop discipline. So maintaining a trading journal instills discipline in your trading approach because it encourages you to stick to your trading plan and avoid impulsive decisions by holding yourself accountable for your actions. So I'm sure if any of you guys have ever traded, you will know how difficult it is to really maintain and stick to your trading plan, especially when it's not going according to your plan. Okay, so next, evaluate strategies. So you can identify which strategies are working well and which ones need adjustment or refinement. So this helps you to basically evaluate the effectiveness of your trading strategies. Manage emotions. So emotions can significantly impact trading decisions. So as I mentioned earlier, when a trade doesn't go according to your plan, having a trading journal basically helps you to manage those impulsive emotions by providing a structured way to review your trades in an objective manner so that it reduces the influence of fear or greed on your trading decisions. So this also helps you to set realistic goals and track your goals so that you can stay focused and motivated. Improve decision making. We kind of talked about this already. Enhance accountability. So when you're keeping a trading journal, it encourages transparency and honesty with yourself about your performance, fostering a culture of responsibility in your trading approach. Okay, so let's look at MyFX book. So MyFX book is a powerful tool for tracking, analyzing, and sharing your trading results. So from setting up your account to utilizing advanced features, we'll talk a bit about how to leverage MyFX book to its fullest potential. Okay, so let's start off with what should you monitor in your journal. So typically, a trading journal should include the date and time of your trade, basically the open as well as close, the instrument being traded, so whether it's dollar yen, euro dollar, gold, WTI, position size, yeah, and then direction, whether you're going in for a buy or a sell, entry and exit points, trade result once your position is closed, profit and loss, at an absolute level as a percentage of the account size and your risk and reward. So how can your journal improve your trading? So we briefly talked about this earlier, but basically, since you are able to review your trading activity over various timeframes, so daily, weekly, or monthly, it will allow you to find the right trading style, whether you are a swing trader, position trader, intraday, or scalper, and identify your strengths and weaknesses, improve your risk management, as well as have discipline. Okay, so how do you set up your trading journal? Basically, you first have to choose a format, decide on what categories you're going to be trading, followed by capturing trade details, analyze trade performance, reflect on the emotional factors, review and adapt, and maintain discipline. Okay, so these are some of the skills that you will be developing when you set up your trading journal. Performance analysis, learning and development, emotional awareness, risk management, trade planning and execution, accountability and discipline, and confidence building. Okay, so let's talk about these examples really quickly. Okay, so there are a couple of examples that we've included here about how to create a Forex trading journal. So this example is in Excel. So by using an Excel spreadsheet, this example over here, so all of these are automated. So this one is manual because obviously you have to type in the data yourself, as you can see in this example here. Okay, but yeah, so this will basically look like, this is what your spreadsheet should look like. With the initial, maximum, the date, the profit and loss. Yeah. Okay. Yeah, and then for automated tradings, you can read this website as well. Okay, there are some which are free and some that you have to pay for. Okay, so the manual option is obviously free since you have to set up the table yourself. So it's really up to you and your own trading strategy. Okay, so you can go ahead and take a look at these two websites. Yeah, I'll go ahead and pop these two websites in the chat as well. So the one that I'm popping into the chat now is the manual one. Okay, and then the automated one is over here. So I won't go too in-depth into how to set up your automated trading journal because I think if you go into the website, it will tell you exactly how to do it. So yeah, let's just move on. You can also look at Forex book. Okay, yeah, so these are just some of our recommendations. Of course, it's completely up to you and your objectives when you're deciding which of these to choose from. But yeah, these are just some of our suggestions. Okay. Okay, let's move on. So let's talk a bit about optimizing your strategy. So a trading journal is not just about recording your trades, but also about analyzing them to identify patterns and areas for improvement. So let's talk a bit about some strategies for analyzing your trades and refining your approach for better results. So firstly, let's start off by talking about the best times to trade. So market volatility happens throughout the week and it varies. So we're going to talk about which days tend to have higher volatility and better trading opportunities. And we're also going to introduce economic calendars and how you can utilize them to identify when market volatility is the highest. Okay, so let's look at what exactly is an FX news calendar. So firstly, on the left, over here, we have investing.com. And on the right is forexfactory.com, which is the one that I typically prefer to use. Yeah, but they're basically about the same. They give you the dates that you're looking for. You can filter the dates. So if you're looking at this week's economic data releases, you can just filter it to look at this week or this month. And then as you can see from these little colored calendars, it also filters by low to high impact events. And it gives you the forecasted values, the previous values, as well as the actual values once the data is released. Okay, so these FX news calendars are important because it allows you to see at one glance all of the important economic data releases. And these data releases often create more volatility in the markets, so it's important to take note of them. So it shows you the key events such as the GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. Okay, so let's understand some high impact events. Firstly, we are looking at the US. So FOMC meetings are the Federal Open Market Committee, and this is the US Fed's way of communicating their view on monetary policies. So these normally come together with a Fed interest rate decision. So if the Fed is dovish, the USD is bearish, and if the Fed is hawkish, the USD is bullish. If interest rate goes up, the USD is bullish, and if interest rate goes down, the USD is bearish. Okay, next we have NFP or non-farm payroll, which measures the change in citizens that are employed from the previous month, excluding the farming industry. Unemployment rate measures the total unemployment of workforce that is seeking active employment from the previous month. Okay, and now crude oil inventory. So these measure the weekly change in the amount of crude held by US firms. So if crude inventories increase, they are inversely related to oil prices, so we can expect oil prices to drop. EIA is Energy Information Admin, and this is a short-term outlook. So it's basically the monthly forecast for the year ahead, the demand and prices across major fuel types. Okay, so some benefits of using the FX calendar. Depending on your individual trading style, it can help to plan trades and allocations for the day, week, or month ahead. And it also helps to alert the individual to upcoming important news events that may affect volatility. Let me know if you guys have any questions so far. Okay, if there are no questions, let's move on. Okay, so now we are getting into kind of the fun part. We're going to talk about some of our favorite techniques, or some techniques that you should maybe take note of. Firstly, of course, I'm just going to touch really quickly on this because we recently finished our Fibonacci series. So if you missed that, I think it's probably uploaded on YouTube, but if not, you can email IronFX on their website and they will probably send you the recording or give you the link. Yeah. So I'm just going to briefly talk about the checklist and what things you should look out for. Okay. So for Fibonacci, there are a couple of steps. Firstly, is the market structure clear? So you want to look for big zigzags, and we want to see, a very clear market structure, so clear up or down. Okay. Yeah. So next, identify the recent trend. So are prices going down or up? So it's important to always follow the general trend. Next is to identify recent major swing lows and recent major swing highs. And lastly, connect the two extreme points from the highest to lowest for a downtrend and the lowest to highest for an uptrend. Okay, so let's move on. Next, which is quite important, is your take profit and stop loss levels. Okay, so for your take profit and stop loss levels, it's important to place your stop loss beyond a key confluence level, or if you look here, a key major resistance level. So in this case, we are going in for a sell since our take profit is below. So since we're going in for a sell, we will place our take profit before any levels. So in this case, it will be above any major support level. And for stop loss, we will place it beyond any major resistance level. So in this case, we're placing it above. Okay, so the reason for this is because price is attracted to such strong areas of Fibonacci confluence, or even if it's just multiple swing high levels that line up in the same area, that's also a major resistance area. So price is attracted to these areas. So if your stop loss is right before these areas instead of beyond it, you will most likely get stopped out before the market reverses. So like you can see over here, we would most likely get stopped out if we had placed the stop loss slightly below. Okay, for take profit, we typically recommend to place your take profit before a key Fibonacci confluence area, because when price reaches any significant area, there is a high chance that it won't be able to go beyond it. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. And this is one of the reasons why people complain that the market is being manipulated, because they might miss that take profit by 1 or 2 pips. Okay? So now let's talk about another technique, which is the trailing stop loss. So in our previous slide, we talked about, we go back. So this is kind of a fixed stop loss template. So if we talk about trailing stop loss, it's a type of stop loss that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trailing stop loss is to lock in profits while giving the trade room to breathe. So basically, it means that the stop loss basically follows the market price as it moves in favor of the trade. So the example I have here is, we're talking about stocks, but the idea is pretty similar if we're talking about currency. So let's say you buy a stock at $100 and you set a trailing stop loss at $10. As the stock price rises to 110, the stop loss will follow, now at $100, since 110 minus $10. So if the stock price drops to $100, your stop loss will trigger selling your position and protecting your profits. The trailing stop loss technique can be useful for traders because it allows them to manage risk and lock in profits dynamically as the market moves. So this is different from a fixed stop loss, which is set at a specific price and does not change as the market moves. So it's important to note that a strict trailing stop loss is not a guarantee that you will exit the trade at the desired price. Market conditions such as gaps or rapid price movements can trigger a stop loss order before it reaches the desired level, leading to an unexpected exit from the trade. Therefore, it's important to use trailing stop loss in combination with a solid risk management strategy. Okay, I just realized I didn't show you guys the FX News calendar that we like to use. So let me do that now. Okay, so earlier I talked about Forex Factory being one of the FX News calendars that we like to use. So if you click on the date, so when you go into the page, it looks like this. And clicking on the date, you can select this week, apply settings, and you get the whole list of news events for this week. So if you click on this green icon, you can see that I've filtered it to only the high and medium impact events. But you can select all, you can filter out the currencies that you're looking at and the different event types, apply filter. And yeah, you can see once the actual result is released, it will update. But it will also give you the forecasted values, predicted values, forecasted as well as previous values, and the currencies as well as the different times. Okay. Also, if you weren't here for the Fibonacci webinars, you can also go onto forexalme.com over here. Okay, and you can click on trading guides. How to draw Fibonacci retracement correctly, and it gives you a pretty in-depth explanation on how to draw Fibonacci's. So we have a couple of videos for you to watch as well. What to look out for, unclear and clear market structures. Yeah, what to look out for, checklist. Yeah. So there are also different techniques for Fibonacci. So we're going, I think in this guide we go through each of them. So we have retracement up above there, as well as the different other Fibonacci techniques. So here we are combining them in order to find Fibonacci confluence levels. Yep, so feel free to go ahead and take a look. Okay, let's get back to my slides. Okay, so let's look at the different methods of trailing stop loss. So here's a summary of the different types of trailing stop loss methods that we'll be going through today. Just really briefly, firstly is the moving average indicator, followed by parabolic star, chandelier, ATR indicator, support and resistance levels, and a combination of these methods. Firstly, we'll start off with looking at the moving average. Okay, so you can see that using our MA, the trailing stop loss is triggered when price basically breaks out of it and moves above the moving average. So I think that's pretty straightforward. You can see in this example as well that it got us out before price started to increase. If we look at a trend line breakout, okay, actually this line here is kind of a trend line breakout. The only issue why we can't call it a trend line breakout is because trend lines have to have a minimum of 3 touches in order to be considered valid. And you can see in this case, we only have 2, okay, before price broke out of the trend line. So when price breaks out the trend line, that's typically a sign that price is going to move in the opposite direction, which it did. So when it moved in this downtrend, so we went in for a sell entry, and then placing this trend line here, we got out when price breaks out of the descending trend line. I think that's pretty straightforward. So let's look at parabolic SAR. So kind of the same concept. Here you see when price moves below the parabolic SAR, it's typically giving us a bearish signal. So when price begins to move above the parabolic star, you can see that it's moving above it. It's even broken out of the top, the upper side of the indicator. Okay, so that's a sign that trend is going to change. Okay, chandelier and ATR, same concept as well. Price is moving below, giving us a bearish signal. Once price moves above or breaks above these indicators, then both of them are triggered and our stop loss, and we get out of the trade. So I think that's pretty straightforward because all of these concepts are pretty similar just by using different indicators so that you can kind of substantiate your analysis to show that, okay, price is really breaking out over here, the trend is really changing, so I should get out of the trade. Okay. In this example, so this is just another example. In this case, we have a fixed stop loss. You can see it's a fixed stop loss at the swing high. Our sell entry is here when price breaks below this line. And also, it's moving below our moving average. Here's our take profits over here. So you can see, instead of just leaving our stop loss here, which you can see is really far away from where price is currently at, by using a trailing stop loss, we can get out of the trade right when price breaks above this level here. Similarly, in this case, price is breaking out of this descending trend line. Stop loss is placed slightly above. Like we mentioned earlier, stop loss should be placed beyond, take profit should be placed before. So we're going in for a sell entry and going towards a take profit over here. Okay. Okay, now let's look at using breakouts as trading stop loss. So breakouts are usually high volatility events, and price can spike up and reverse almost as quickly. So a stop loss will help you to manage risk, protect your capital, and a trading stop loss can help you to protect your profit like we've seen in the previous slides. Okay, so let's move on to our next technique. Okay, trend trading. So here's a super simplified breakdown of how trend trading works. Firstly, you want to identify your trend. So in a price movement of a currency pair. So this is typically done by analyzing historical price charts, and an uptrend is characterized by higher highs and higher lows, while a downtrend is characterized by lower highs and lower lows. Okay, so entry points. Once you have identify a trend, the next step is to find an entry point. So in an uptrend, you might look to enter a trade when the price has retraced or pulled back slightly from its recent high. So basically, you're anticipating that the trend will continue. But in a downtrend, you might look for a retracement before the price continues its downward movement. So next we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So stop loss is a predetermined price at which your trade will automatically close to limit potential losses if the market moves against you. So a take profit level is where you decide to exit the trade to lock in profits before the trade potentially reverses. Number 4, riding the trend. So once you're in the trade and the trend continues, you aim to stay in the trade as long as the trend remains intact. So basically, in this situation, you would be monitoring the price movement and adjusting your stop loss and take profit levels if needed. or you might choose to use a trailing stop loss that we just went through as well. Lastly, exiting the trade. So this typically happens when the trend reverses. But yeah, trends don't last forever, so it's important to be vigilant and not get too greedy. And remember to decide to exit your trade and take your profits where possible. Practice analysis. So I think that's pretty self-explanatory, so I won't get into that. Okay. So pullback support and resistance. So these are pretty basic trading knowledge, I suppose. But basically, a pullback support is a strong level of support which breaks out from a previous resistance level, and price is now dropping back to visit it again. So pro tip is when a pullback support lines up with a Fibonacci level, it tends to be very powerful. Pullback resistance, on the other hand, works well when it breaks a significant swing low and then starts pulling back to it. Even better if there are multiple Fibonacci levels that line up with it. So here's an example. So you can see at the red area, price tested this level 3 times with multiple swing highs in line with one another. And once price breaks the red area, it becomes a pullback support level. Then we expect price to pull back or retrace this level, which you can see from the dotted arrows. And this is an example of a pullback resistance. So you can see once price breaks the level, it becomes a pullback resistance, and we expect price to retrace and pull back to the same level, like you can see from these red arrows. Okay, now pullback resistance. Here we have a swing low, and thus a possible support level. With price passing below the swing low support, it is now a pullback resistance. Okay, so if we see in the next slide, you can see that price actually pulls back to this resistance level. Yeah, and once it reaches and reverses off the pullback resistance level, it then becomes an overlap resistance level. Okay, which we will get into now. So overlap resistance occurs when price reacts off a particular level from the top and from the bottom. So the more times that it reacts off this area, the stronger the overlap area. This basically means that there are bulls and bears that are respecting that area, so it's important to take note of that. Okay, so here the pro tip is that if the overlap area lines up with other elements, such as Fibonacci or graphical elements, it will make it even stronger. So that's basically what we call the confluence areas. Yeah, that applies for any support and resistance level that you can find. If you can support it with your Fibonacci, your pivot points, your pivot point indicators, that would be even better. Okay, so here's an example. Basically, you can see how once price breaks below the support at 105.643, you can see how price retraced or pulled back to this resistance level and reversed off of it, making it now an overlap resistance. Okay, here's another example. So here we have a big swing high resistance level. Price surpasses this level and becomes a pullback support where we expect price to pull back to that level. So in the green areas over here, we see price retrace this level and actually bounce off perfectly. So once price bounces off the pullback support, it then becomes an overlap support. Okay. In our second example, we see two swing highs lining up. So we have a swing high resistance. So price has surpassed this level as well and making it a pullback support. Here we can expect price to retrace to that level. So you take note of the blue circles. Price bounces off this level twice, making it a strong overlap support. Okay. Okay. In this last example, we have multiple swing lows that are in line at the 33420 level. So once price breaks this level, it becomes a pullback resistance. We can see price has tested this level 3 times, 1, 2, 3 over here, making it a strong overlap resistance level. And then once price passes again, then it becomes a pullback support. And once it bounces off that level, it then becomes an overlap support. I think by now you guys have gotten it. So let's move on to our last technique. Okay, so how do you identify a trend? Okay, I briefly talked about this earlier. So how you can identify trends is obviously you can just look at the charts and you tend to be able to identify whether it's ascending or it's moving in a downtrend or whether it is ranging. But if you want to be extra certain, you can try looking for trend lines and trend channels. So what makes a valid trend line is if there are at least 3 significant touches. For an ascending trend line, the touches should be on the bottom and on, so if it's descending, then the touches should be at the top. So here's another example. Okay, you can see the touches on the bottom and here as well. For descending trend lines, it should be on the top and on the bottom, but same thing, we are looking for at least 3 significant touches. So you can see here we have about 4, and here we have about 4 as well. Okay, so watch out for at least 3 significant touches for it to be considered a valid trend line, like over here. Okay, and you can see on the 4th touch, price is playing the reaction. Okay, so let me know if you guys think that this trend line is valid or not in the chat. Okay, someone said that it's not valid. Yep, so it is not valid because we mentioned that if it's a descending trend channel or trend line, the touch has to be on the top and not on the bottom. Okay, so if we look at drawing valid channels, the valid channels are if there are at least 4 significant touches, 2 at the top and 2 at the bottom. Okay. Over here, this is an example of a descending trend channel. So it doesn't have to be consecutive like this or like this, but just as long as there are 2 touches. Okay, now let's look at the different indicators that you can use to identify the trend. Okay, so firstly is Ichimoku cloud. So breaking down the lines, it consists of several components, and it's basically composed of 5 lines or calculations, 2 of which comprise a cloud where the difference between the 2 lines is shaded in. The lines include a 9-period average, a 26-period average, an average of those 2 averages, a 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. Okay, so let's look at breaking down the lines. So basically, when the price is below the cloud, the trend is bearish, or the signal over here is bearish. When price is above the cloud, the trend is up, or the signal is bullish. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud is moving upwards, or during a downtrend, the bottom of the cloud is moving down. Okay, so let's break down the different lines. Okay, we have the Tenkan-sen or conversion line, and this is the average of the highest high and the lowest low over the past 9 periods. The Kijun-sen or baseline is the average of the highest high and lowest low over the past 26 periods. Chico's span or lagging span is the current closing price plotted 26 periods behind the current time. And Senko span A or leading span A is the average of the Tenkan-sen and Kijun-sen plotted 26 periods ahead of the current time, used as a leading indicator of the trend. Okay, Senko span B or leading span B is the average of the highest high and lowest low over the past 52 periods, plotted 26 periods ahead of the current time, used as a leading indicator of the trend. Okay, explaining the lines. So the first way to use Ichimoku is to identify trends. Basically, the Tenkan-sen and the Kijun-sen. Tenkan-sen is the one in blue, Kijun-sen is the one in red. Those are used to identify the trend of the market. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen, and a bearish trend occurs when the Tenkan-sen is below the Kijun-sen. Okay, you can also use your Ichimoku indicator to determine support and resistance levels. Okay, now the third way to use Ichimoku is for confirmation. So the Chico span is used to confirm the signals that's generated by the other lines. And if the Chico span is above the current price, it confirms a bullish trend. If the Chico span is below, then it confirms a bearish trend. Okay? So Ichimoku generates buy and sell signals based on positions of the various components. So for example, a buy signal is generated when the Tenkan-sen crosses above the Kijun-sen and Senko span. And a sell signal is generated when the Tenkan-sen crosses below the Kijun-sen. Okay, so how can you effectively use this indicator? So basically, the overall trend is up when the price is above the cloud, and down when the price is below the cloud. Yep, and trendless or transitioning when the price is within the cloud. Okay, so of course you can also use support and resistance, as we mentioned earlier. So yeah, so you can see when price is moving below the cloud, it is bearish. When price is moving above the cloud, then it's bullish. Within the cloud is typically transitioning. Okay, another way is price and MA cross. So if you're a beginner, this is a great way to identify moving averages of different periods to analyze price movements and generate buy or sell signals. I won't get into it, but yeah, this strategy basically captures trends and works best in trending markets. Next, we have the Golden Death Cross, which is a strategy based on the intersection of two important moving averages on a price chart. Okay, so I'm not going to explain how the indicator works, but basically when price When you see a golden cross, it's a bullish signal. When you see a death cross, then it's a bearish signal. Okay, channels as well. You can see when price hits the sides of the channel, that's typically a sign that price is reversing off of the channel. Okay, so when you are deciding which settings to use for your moving averages, try and make sure that it touches the bottom of the bottom or the top of the price as much as possible. Same for natural moving averages. And a double break is basically when price breaks below the moving average as well as your trend channel. So basically, as I mentioned earlier, when you have an analysis, you want to try and make sure that you use different indicators to support that analysis. Okay? Yep, so that's what we call confluence. You can see in this case, we are using a trend channel, Ichimoku, as well as moving average, as well as your death cross. Okay, you can see we see this price moving upwards. Okay, so to wrap things up, we'll quickly go through the disadvantages of trend trading. So basically, it can give you false signals, late entries, some choppiness as well, whipsaw trades, which basically means that traders enter and exit positions quickly due to volatile price movements, which can result in losses. Limited profits in ranging markets, and it might require timely decision making. And lastly, noisy price data. So to overcome it, you want to make sure that you have all of these in check. And how you can make sure these are in check is by basically making sure that you use a trading journal so that you can track your trades, track your strategies to see what works and what doesn't. Okay, and this is just to show you guys what an unclear market structure looks like on a 15-minute time frame. You can see it's pretty messy. There's no clear price movements. But when we change to 1 hour, you can see it's pretty clear. Okay, so yeah, so this is just a kind of a rule of thumb to live by. So if the clearer the swing low, the clearer the swing high, the clearer the trend between these 2 points, the more accurate your analysis will be. Okay, that brings us to the end of my slides. Thank you guys so much for joining me today. I hope you guys found this helpful. And yeah, have a great rest of your week, and I'll see you guys next week. Bye, everyone. Thanks, everyone. Bye.